Welcome to my presentation, Accounting Basics number 2 Double Entry, presented by Sean Bourne. Double Entry System. Double Entry System is a system where every transaction has a double effect, dual effect on the accounts or books of a business or an organization. One account will show an increase or decrease, and the other account will show an increase or decrease. Every debit entry has a corresponding credit entry. The double entry system divides each account into two halves. The left-hand side of the account is called the debit side, while the right-hand side is called the credit side. Title of each account is written across the top of the account center, T accounts. Assets and expenses accounts carry debit balances. Liabilities, capital, sales or revenue accounts carry credit balances. So here is a T account. Left hand side, debit, center of account, title of account, right hand side, credit. Double entry rules for bookkeeping are: account, assets. To record an increase, we need a debit entry. A decrease, credit entry. Liabilities. To record an increase, we need a credit entry. A decrease, a debit entry. Capital. To record an increase, we need a credit entry. A decrease, a debit entry. Expenses. To record an increase, we need a debit entry. A decrease, we need a credit entry. Sales or revenue. To record an increase, we need a credit entry. A decrease, a debit entry. Word example: January 1, 2020. Started a consulting business, putting $5,000 into a business bank account. Effect: here increases asset of bank, increases capital of owner. Action: so we debit bank account, credit capital account. January 03. Bought machinery on credit from JMV Machines, $1,000. Effect: here we increases asset of machinery, increases liability to JMV Machines. Action: debit machinery account, credit JMV machine account. January 04. Withdrew $400 cash from the bank and placed it in the cash box. Here we increases asset of cash and decreases asset of bank. Action: debit cash account, credit bank account. January 07. Bought a van paying in cash, $300. Here effect: increases asset of van, decreases asset of cash. Action: debit van account, credit cash account. January 10th. Sold some of the machinery for $200 on credit J. Brown. Here we increases asset of money owing from J. Brown. Decreases asset of machinery. Action: debit J. Brown account, credit machinery account. January 15. J. Brown paid the firm the amount owing $200 by check. Here increases asset of bank, decreases asset of money owing by J. Brown. Action: debit bank account, credit J. Brown account. January 31. Pay the amount of $1,000 to JMV Machinery by check. Here we decreases liability to JMV Machines, decreases asset of bank. Action: debit JMV Machine account, credit bank account. Here T account entries. Bank account. Debit side. January 1, receive capital into the bank, so we debit $5,000. On the credit side, January 4, we withdrew cash from the bank, so we credit $400. On January 15, we received money from J. Brown, so we debit $200. January 31, we pay JMV Machines $1,000, so we credit the bank account. Cash account on the debit side, January 04, we receive money from the bank $400, so we debit cash $400. On the credit side, January 07, we bought a van, paying cash $300, so we credit the account. Capital account on the credit side, January 1, we receive money of $5,000, so we credit the capital account. Machinery account on the debit side, January 03, we bought machinery on credit from JMV Machines $1,000, so we debit the account. January 10th, we sold some machine to J. Brown for $200, so we credit the machinery account. JMV machine account. January 03, we bought machinery $1,000, so we credit them account. January 31, we pay them $1,000, so we debit their account. Van account on the debit side, January 07, we bought a van by cash $300, so we debit the account. J. Brown account on January 10th, we sold them machinery $200, so we debit the account. On January 15th, they pay us $200, so we credit their account. Give this video a like, share, and subscribe.